When we look at the stock market, we are witnessing an unprecedented move. They continue to rise further and further without stepping back. We are in a new phase of euphoria. This is a constant, repeated message that we are seeing of this time is different. Funny that we tend to hear that right before the end. You came here for the truth, so let me unveil that for you. This is what will happen to the stock market if history is any guide. We are going to look at some charts that will explain to us if the same thing that's been happening every single time happens again. This is what we are about to face. Doesn't mean that this is going to happen, but it's a good guide to follow. Now, what we are looking at here is the S&P 500 over the last few decades, beginning 1970 up until present day. And there has never been a time before where we have seen such a parabolic rise over such a long period of time. You see different cycles that appear over the years, and there's always these events that take place which cause a correction in the price. You'll see what happens throughout history. But we are now at nearly a decade of consistent, record-breaking rises that have been taking place. And over the past year, we have witnessed month after month after month of new gains, breaking records. When we look back in the pages of history, we need to address what had occurred then to be able to predict what happens in the future. Let's take a look at this. By the way, Real Investment Advice is the website where these charts are from. Look at 1980 to 1987. You've probably heard of the crash in 1987, a significant drop in a very short period of time, historic in fact. So there are generally three phases to any bull market. It begins with little to no attention, and then it begins to pick up before prices go into parabolic territory. And it is when those prices get into that territory where we have a retracement. It may happen in a flash, or it may take a little while, but usually what I've noticed is that it happens significantly faster than the rise up. And that's very dangerous because people can't sell, they can't get out. And then they have lost such a big percentage in such a short period of time that they want to hang on. And they hang on and the price drops further. And then they get to the bottom and now they really don't want to sell, so they hang on. But it could take many years, 10 years, 15 years. Look at some of these stock markets out there that took decades to get back to where they were. Doesn't necessarily mean that that will happen again, but it is a good guide. Now this was the 1980s. Let's move on to show you 1990 to 2000, a decade of persistent increases, where you can see, again, marginal increases throughout this time up until 95, where things started to pick up. Interest rates continued to decline. There was more prosperity in general. Market sentiment was good. But of course, this is the time of irrational exuberance. And then we get into the technology stocks booming. And while the whole market wasn't the cause of all of that, these technology stocks, their PE ratios, of course, off the charts. You saw during this time how it really expanded further and affected more than just technology stocks, more than just what it technically should have, because everything is interconnected. You need to remember that, how things are interconnected. You could say, look, it's not technology stocks. It's not, in this case, the housing market subprime. Remember how subprime really came out and showed his true face of how the derivatives are all laid out in front of us. They are there staring at us in the face, but we're not allowed to really address the real concerns. Don't touch that. Don't touch derivatives. Just stay out of it. Let's not talk about it. Think about this. We have derivative products, and I argued with somebody who works at Scotiabank. I'll just leave it at that. Nobody high level anyway, but I made the claim in my first book. I asked him to read a chapter, and he said, "You can't say this. You can't say that derivatives are bad. You can't just make that blanket statement." And I stood by that comment, and I published that comment simply because I don't agree with the concept of derivatives. Look at what happened during the financial crisis. It's a perfect example of why we shouldn't have derivatives. Leave it in the laboratory. Leave that kind of thing in the laboratory, in computer models, and not in basically things that could affect people's pensions and people's, their children's college funds and everything else. That should be left just in the fictional world. It's too risky. And we saw that taking place with the CDOs, right? Big problems. So again, during this time frame, you saw quite a significant rise in this case, but it wasn't until right before the end that the significant rise came in, and of course, we all know what happened. It was during this time frame, 2006, and then I would say into 2007, where we had a handful of people warning about what's happening. Of course, they were shut down. They were told they were ridiculous. I mean, imagine you were in 2006. You were warning about the real levels of irrational exuberance, of the Federal Reserve not increasing interest rates to the rate that they need to be. The stock market was getting overheated. Subprime was a very, very big problem, and we are noticing the weakness out there. The cracks were appearing. People were getting homes they shouldn't have. You know the drill. Imagine how ridiculous you would have looked up until this moment here. I mean, this entire rise. You would have been so ridiculous. You would have been just ridiculed beyond belief. But that's what happened. And these few people, up until that moment, were just shut down. But then, of course, on the way down, these people, their book sales increased. They were getting interviewed on all the CNBC and Bloomberg and everything else. And now they're ridiculed once again. Sometimes it's not very good to be early to the party, but anyway. Don't worry, the central banks have this. The market will never go down again. We have seen one of the most unprecedented booms in stock market history because the central banks are actively buying shares, buying debt, buying corporate debt, buying basically everything, all the toxic assets. Where do they get the money? Does anybody know? I think, there's a buried treasure that they go to the bottom of the ocean. They dig it up and they have it. It's all kinds of different buried treasures, and they use that money to buy up shares. No, actually, that's not true. They print money out of thin air and they decide which companies will benefit. I can't help but think that that's not a good policy for you and I. All right. We saw what happened during the rise since 2009. March 2009, the bottom here, 666 on the S&P, rising upward. And now where we have it today is literally a parabolic rise. Throughout 2017, month after month, we're seeing the new record highs. And then now we are seeing simply a parabolic rise that's going up. Barely any declines. The VIX is ridiculously low at this time. This is another chart showing you this back from 1930 up until present day. I mean, people want to say, they want to point to different markets around there. Look at what's happened. These are the previous 2 instances, and it has gone far beyond that. Now, the nominal price to me doesn't really mean much. What I like to see is compare it to other metrics out there. Compare it to other indicators. That's when I have a problem. Look at the VIX. I've covered it before. Throughout December, it's tracking the S&P, and then we get to basically the beginning of the year, and it's completely out of whack. The VIX just keeps going down. It's consistently declining. Sure, there are little spikes along the way, but ultimately the market is not afraid of anything because they have something to protect them. And it's a very, very important tool that is used, and it's called the Fed. The Federal Reserve is there to be the lender of last resort, and in some cases, not even last resort. They'll be there to buy up everything if needed. And this year, I just wanted to show you, not suggesting that we're going to hit 1987, but look at what the USD index did in 1987. Starting off the year, you could see where on average it goes, but 2017 is the worst it's been since 1987. It's very early, too early to tell, but I just thought I would make note of it. So I hope you found it interesting. I mean, just imagine the US dollar hitting that same slope. I'm not sure if that's going to be the case, particularly when all other countries around the world are engaging in the same policies of reducing the value of their dollars and of their currencies. And I think it's really saddened. It saddens me to see that because ultimately people get hurt whenever there's a devaluation of the currency. It's not a good thing. If your country has a stronger currency, that's okay. There are other ways to deal with it other than devaluing it. It's not a good thing. But again, that's my opinion. There's a lot of Keynesians out there who enjoy that devaluation and think that a nearly 99% reduction in the value of a particular currency is good over a longer period of time. I happen to disagree with that. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. So of course, I do appreciate that very much. Now, if you found the video informative, I know you're going to find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. The first book is about the 4 asset classes and how to profit from it, whereas my newer release is about earning income, reducing your monthly expenses, and I also touch on familiar subjects from the first book. So they're both individual in their own way, although I do cover familiar concepts. So check those out. The links are in the description below. Take care.